and uses. This lesson reviews common uses for annuities and explains when annuities may be suitable for meeting a person's financial objectives. Uses of annuities. While they can be useful anytime there's a need for long-term accumulation and distribution of money, annuities are most commonly used for retirement planning. Tax-deferred growth makes deferred annuities useful in saving for retirement, while immediate annuities, especially those with a life contingency, play an obvious role in providing lifetime income for both individuals and couples. Using deferred annuities to accumulate money. Because they grow on a tax-deferred basis, deferred annuities may realize greater net returns than comparable taxable investments, for example, CDs. Money that would have been paid to Uncle Sam can instead be plowed into the annuity, magnifying the power of tax deferral. The use of deferred annuities to accumulate funds makes most sense when done with long-range goals in mind, especially goals that include the long-term distribution of those accumulated funds at some future point. At one time, annuities were used for medium-range goals like college savings. However, distributions from a deferred annuity before age 59.5 are now subject to a 10% penalty tax, in addition to ordinary income taxation, dimming their popularity for anything other than long-term accumulation and distribution. Key point. Income taxes are payable on deferred annuity earnings when they are distributed. If a deferred annuity is surrendered, the interest portion of the distribution is fully taxable in the year of the distribution. A 10% penalty tax may also apply if the owner is under age 59.5. Annuitizing the contract effectively spreads out the taxes for the term of the selected settlement option and avoids pre-59.5 penalty taxes, creating another reason to annuitize a deferred annuity. Annuity taxation is more fully discussed in a later lesson. Death benefit adds assurance. All deferred annuity contracts include a death benefit provision. This assures contract owners their accumulated funds will be paid to their beneficiaries should they die prematurely. For fixed annuities, the death benefit is the annuity's current accumulated value at the time of death. For variable annuities, the death benefit typically equals the greater of the account value or the total sum of premiums minus withdrawals. Other death benefit options may be provided. Using annuities in qualified retirement plans. Because they are structured with long-term accumulation and lifetime income payments in mind, annuities are commonly used as the funding vehicle for qualified retirement plans, including IRAs, SEPs, or 403(b) tax-sheltered annuity plans. Key point. Choosing an annuity to fund a qualified plan should not be based on its tax deferral feature, since the qualified plan itself makes the growth of the funds tax deferred, with or without the use of an annuity. Likewise, premiums paid into a qualified retirement plan are tax-deductible whether the asset is a deferred annuity or another form of asset. An annuity is most suitable for retirement planning purposes when the contract owner intends it to provide guaranteed lifetime income, something other retirement planning instruments except traditional pension plans cannot do. Structured settlements. Annuities are used to distribute funds from lawsuit settlements and winnings from state lotteries. A person injured in an accident or by another party's actions is often awarded a sum of money through a court settlement. In many cases, a settlement award is not paid all at once. Payments over time may be required. Similarly, a state lottery board may offer winners a choice in how to receive winnings, for example, a lump sum amount or installment payments over 10 or 20 years. In both cases, structured settlements are used to distribute the award in a guaranteed manner. Because of the certainty and guarantees they represent, immediate fixed annuities using a period certain only settlement option are commonly used in setting up a structured settlement. Annuity suitability. While they can be ideal for people looking for guaranteed lifetime income or long-term tax-deferred accumulation, annuities are not for everyone. For example, potentially steep surrender charges, lasting 10 or more years, can make deferred annuities unsuitable for seniors who are simply interested in a place to hold their savings. Potential tax penalties and surrender charges on withdrawals make their suitability questionable for anyone under age 59.5 looking for a place to save for short or medium-range goals. An immediate annuity may not be suitable for someone with a limited life expectancy, unless the settlement option selected includes income guarantees. The scenarios described above may benefit with an annuity, but suitability can only be determined after carefully analyzing the customer's goals and understanding the products being recommended. Most states have adopted regulations that require agents to determine the suitability of all annuity recommendations, especially those involving seniors. Increasingly, states are requiring two types of annuity suitability training for agents who sell annuities. Carrier-specific training, in which insurers provide product training for any agent selling their annuity products. Industry-specific training that requires agents to complete a one-time annuity training program, minimum 4 hours, provided by an approved education provider, before becoming licensed. If your state has specific annuity training requirements, they are covered in the state law section of this course. Contract charges must be disclosed. There are premium and contract charges that reduce the contract's accumulated value over time and surrender charges that can significantly reduce the size of distributions during a contract's early years. Agents are obligated to disclose these fees and charges when discussing annuities with prospective customers. For your review, choosing an annuity to fund a qualified plan should not be based on its tax deferral feature, since the qualified plan itself makes the growth of the funds tax deferred, with or without the use of an annuity. An annuity is most suitable for retirement planning purposes when the contract owner is seeking guaranteed lifetime income. Structured settlements use annuities to distribute lump sum lawsuit settlements and lottery winnings. Potentially steep surrender charges can make deferred annuities unsuitable for seniors who are simply interested in a place to hold their savings. An immediate annuity may not be suitable for someone with a limited life expectancy. Please pause the audio and watch the video. You can restart the audio playback at any time.
Many uses. They can be used purely as a means of liquidating a sum of money, providing a stream of income, or they can be used for accumulation purposes with the ultimate objective of distributing that in the form of annuity income payments. While they are particularly well suited for a person needing a guaranteed stream of income for his or her life, deferred annuities can be used strictly for accumulation purposes, but one needs to be careful if that's the reason for buying an annuity. And in fact, while there are many ideal solutions for people looking for assurance that they cannot outlive their income, annuities simply are not for everyone. Past abuses selling annuities where they are not suitable has left to tougher regulatory scrutiny in the area of annuity suitability. And you can expect a number of questions on your licensing exam dealing with this question of annuity suitability. Let's just review a couple of the key points that you want to keep in mind when the topic of annuity suitability comes up. And first of all, most deferred annuities have some fairly steep surrender charges that can make them very unsuitable for anybody that's going to be taking withdrawals from that annuity within the surrender charge period. Now, for many people, younger people, that might not be an issue. But for seniors, it can be a very serious issue. And in fact, it's abuse in this area that has brought a lot of regulatory attention on certain producers who were selling deferred annuities to seniors. So you want to make sure that when you're selling a deferred annuity, that the buyer is in a position to either go beyond the surrender charge period, or if they need to withdraw the money, that they fully understand that there are surrender charges involved. Furthermore, withdrawals before age 59 and a half can be subject to not only regular income taxation, but a 10% penalty tax. Something else to consider for somebody that's thinking of taking a withdrawal from a deferred annuity. Quite simply, an immediate annuity may not be suitable for somebody with a limited life expectancy. So, I realize that there are annuity payment options that have guarantees built in them, but you want to make sure that when you're speaking with a customer and they're talking about annuitizing an annuity or buying an immediate annuity, and there's a life expectancy question there, everybody needs to be fully aware of what's involved with the annuity options selected. And then lastly, choosing an annuity should not be based on the fact that it is a tax-deferred investment if the purpose of that annuity is going to be used in a qualified retirement plan, like an IRA. And that's because the fact that it is a qualified plan, say the IRA, generates the tax advantages that an annuity offers, which is another way of saying you're duplicating the benefit for no real purpose. So keep those issues in mind as you're looking at annuities and ask yourself, is this product really suitable for the customer and their needs?
Okay, everyone, here is the 4 questions that you may see something like when the test. Bless me. All right. A deferred annuity would be suitable recommendation for all of the following needs except. So the one of these is wrong. Joe, age 23, wants to save money for a European vacation in 5 years. Would be my guess. A vacation, you can find another way to save it for a vacation. For which of the following purposes are annuities most often used? I want to say retirement planning. I'm not sure this is right, but annuities offer all the following benefits except retirement and income. The annuitant cannot outlive. Tax-free distributions. I want to say it's either this one or that one. All right, in which case would an immediate annuity not be a suitable product to meet the need described? And I want to say distributing funds from a lawsuit. Now, I don't have the answers to all of these, so we're going to see what the answers are together. All right, so I got one wrong. I didn't do too bad. All right, the last one is funding a limited life expectancy. That is what an immediate annuity would not be suitable for. So if you see those kind of questions on the test, then you know that is not correct. All right, so the rest of these, let's look at them. I got them all right. I have no idea how. Trust me, I didn't take this before. All right, the vacation just makes sense. It wouldn't be suitable for a vacation. You can find other ways to save up for a vacation. Get a savings account, right? All right, so people most use annuities for retirement planning purposes. That's kind of common sense. All right, while earnings are tax deferred in a deferred annuity, when the income taxes ultimately have to be payable when those earnings are distributed. And additional penalty taxes also, if you are under 59 and a half, they charge a penalty tax. Okay, so that's it then on this chapter here for annuity suitability. And if you need to watch it again, look for that in the title. The next one is taxation of life insurance and annuities. Thanks everybody for watching this long if you made it to the end.